Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest podcast. Let's get started. Hello, DealQuest community. Corey Kupfer coming to you with another solo cast of the DealQuest podcast. And I want to talk about something that's in the news right now, but it is a general, deal thing. Although this is at a level that most of you are never going to be in a position, and frankly, not at a level that we do deals at, because this is for big public companies. And we do deals. We generally represent private. We do some very big deals, and we represent large companies, but they're usually privately held. But I thought it was just interesting because it's in the news, and so this is just more educational in general, for folks, and it does affect the deal. The deal, is in the context of deals. So what I want to talk about, many of you may have heard that Twitter is in play, and that Elon Musk from SpaceX and Tesla and you name it, right? Has already bought up 9% of Twitter stock, and is talking about buying more and potentially taking over the company. Now, this is what is in the industry called a hostile takeover, because it's the Twitter board is not in favor of it, so it becomes a hostile takeover attempt. And those of you who've been around for a little while, or in the deal space, or just read up about this, know that hostile takeovers are not new. It was certainly way more prevalent in the 80s, let's say. When you had, all these corporate raiders, so to speak, and all this folks doing these hostile takeovers, you heard a lot more about it. And one of the reasons why you've heard less about it in recent years, although it does still happen, is this concept of a poison pill. And one of the things that inspired me to record this solo cast today, which is, it'll air, we're going to put this one out pretty quickly, is that on the day I'm recording this, which is on April 15th, Twitter board, there was an announcement that the Twitter board adopted a poison pill to try to prevent Musk, or theoretically anybody else, from taking over the company. And now what is the poison pill? And that's the general sort of name for it. You'll hear the more formal term, shareholders' rights, provision, but what it is there are various variations on it, but they all tend to do most often one thing, which is that they allow everybody except for the hostile takeover persons, but they usually phrase it down generally. So let's say, hey, this applies to everybody except anybody who's newly acquiring equity at, above a certain threshold. So for example, in Twitter's case, they said above 15%. So Musk owns 9% now. If he hits 15%, or theoretically, if anybody else comes in and buys 15%, it triggers this shareholders' rights, action, and the poison pill, the shareholders' rights plan. And under that plan, all the existing shareholders get to buy additional equity at a reduced price. So what does that do? What that does is it dilutes the equity that Musk, in this case, has, right, that the hostile acquirer has. It dilutes it down, and it dilutes it down not just because you're issuing more equity, but you're issuing more equity at a lower price. So it makes the company way more expensive for the hostile acquirer to buy. And it's been a pretty successful tool, although not universally it's worked, but it's been a pretty successful tool in general. In fact, there are some examples where prior companies over the last number of years have done this at times when they've been, threatened. So, for example, one example is in July of 2018, Papa John's adopted a poison pill. And that was an interesting case, because that was a case where the founder of Papa John's, who had been kicked out because he used a racial slur, and there was a big backlash, understandably, and they resigned. he was looking to get back in and actually, hostily acquire back the company that he founded, and and had obviously his equity had been diluted over time, and was looking, to get that back, and they put in place a poison pill that would allow stockholders to buy stock at a discount if John Shatner or any of his family members, he was the original founder, raised the equity stake in the company to 31% or more, or if anyone else bought at least 15%. So they ended up settling that out, in March of 19 in an undisclosed settlement. So you would assume that the Shatner family and John Shatner didn't get all they wanted, but in some ways, maybe the company gave up something, but the poison pill worked to at least some extent there. So really, the goal here in this poison pill, in Twitter's case, is to flood the market with new shares that would, if Musk or anybody else hit 15%, that would immediately dilute, his interest in the company. So, and that's similar to what Papa John's did, for example, and that's the common approach. There was another example back in 2012, November, when Carl Icahn and his group looked to take over, in a hostile takeover, take over Netflix. And Netflix used a poison pill that similarly would have made it way more expensive for Icahn and his group to accumulate more shares of Netflix without approval of the company board. There was another situation for Men's Warehouse in October 2013, where Joseph A. Bank looked to take them over, and Men's Warehouse survived it. And then, interestingly, both companies ended up filing bankruptcy later because it actually went the other way. Men's Warehouse acquired Joseph A. Bank in March 2014, and then they all went bankrupt in August of 20. So, who knows whether that was a good outcome. But they used this poison pill to stave off a hostile acquisition when it was Joseph A. Bank trying to acquire Men's Warehouse. There are also some examples of companies that have done this even when they're not under threat. And this is one of the reasons why these hostile takeovers have become a lot less popular than they were in the 80s. It's not just that companies institute poison pills at the time, but they actually build in poison pills to their bylaws and their charters and their and their structures, just even before there's any threat. And the advantage of that is that so one of the issues with a poison pill is that it could be challenged, right? The board has a fiduciary duty to do what's in the best interest of the shareholders always. Now, the argument for the poison pills is that, hey, we don't think, like Twitter's board, I'm sure it has minute. I'm not involved, by the way. So when I say I'm sure, I'm just sure because I know how these things go. I have no inside knowledge. But I'm, my guess, or I'm pretty sure that, in the minutes that were discussing the approval of the poison pill by Twitter's board to thwart Musk, they did a full discussion on all the reasons why this is best for their shareholders. They would have to come to the conclusion that the takeover by Musk would not be better for everybody, even though, by the way, he, like most acquirers, was offering an offer price that was above the company's stock price, right? So, in theory, if he's willing to pay that, the stock price should go up, which would benefit the shareholders. So they have to jump through some hoops to show, hey, there are more, downsides to that potential acquisition with what, in this case, Musk would do with Twitter that would hurt, that they honestly, in their fiduciary capacity, feel would eventually hurt the company. And therefore, the company is better off trying to thwart that and putting the poison pill in place. People can challenge that. Shareholders, including Musk, right, because he's already a 9% shareholder, could challenge that board decision as a breach of fiduciary duty and try to show that it's not in the best interest of the company, and therefore it was an improper action by the board.
Let's take a break from the show for a minute so I can invite you to a new way to determine your deal readiness. I created a fast and easy assessment that will determine exactly how deal ready you are. Once you complete the assessment, I use your responses to identify the obstacles that are holding you back from being a deal-driven growth genius. It's as easy as heading to CoreyKupfer.com/assessment. That's CoreyKupfer.com/assessment and filling out a few multiple choice questions. I'll be checking in after the episode to see what your results are. Now back to the show.
Now, let me talk about something here that does relate to some things that we do more often for clients, and that is jurisdiction choice. Most of these public companies are formed in Delaware, and there's a reason they're formed in Delaware, because on those kind of shareholder derivative suits, those kind of lawsuits where a shareholder may sue the board members to say, hey, this poison pill, for example, there's just one example, this poison pill, for example, is not in the best interest, you breach your fiduciary duty. Or this comment applies to any kind of breach of fiduciary duty claim with a minority or any minority owner feels that the majority owners or the board is acting not in their best interest. Delaware statutory law is super favorable to management, majority owners, control people in these kind of decisions. Yeah. Now, listen, let's be clear. What you can't do is you can't do something that's criminal or really self-dealing or only benefits you. But if you are making a decision that has justification that you thought it was in the best interest of the company, by the way, even if it turns out to be a bad decision, right? You're allowed to make bad decisions. You just have to make them in good faith and show that, you were looking at in your mind, or in the board's mind, the majority shareholder's mind, that you were acting what you truly thought was in the best interest of the company, right? Whether you end up to be right or wrong. And that, you acted, in the scope of what a reasonable, management board, et cetera, would do. It's very hard to break through that for example, in Delaware under the statute. Now, there are some other states, like, for example, Nevada and Wyoming, that adopted very similar statutes. The reason why us lawyers tend to keep companies in Delaware is that Delaware has not only a very favorable statute, but it's got over 100 years of case law and a lot of case law with these public companies, because there's much more litigation in Delaware because so many public companies were formed there. Because Delaware was smart many years ago. They said, that we're a small state, and this was a huge revenue raising opportunity for them. And they've made a lot of money over the years for companies registering there and paying their fees. So most of the case law is in Delaware. So in any case, it's a little aside, but it's the reason why whenever we have a client that is going to have any kind of minority ownership, either up front or certainly if they're going to raise capital, going down the line, or maybe do acquisitions where they're going to give minority ownership or even minority ownership to employees, we always recommend that they be in Delaware because it protects the company and the founders and the majority shareholders of the board against those types of claims. So what does that mean in terms of the poison pill? Well, what it means is that these things are hard to challenge because, one, these companies are likely in Delaware or in a similar state. Number two, it's basically called the business judgment rule. If their business judgment seems to be sound, they can't be challenged. Number two, the firms have gotten very sophisticated in making sure they properly justify these decisions as proper business decisions in the best interest of the shareholders. So it's even harder to meet those standards. Not impossible, but way harder. So how this relates to the conversation of companies that have put the poison pill in place after a triggering event, like Musk getting 9% saying he wanted to take over Twitter, or the ones that I started to talk about who have just put it in place up front, is that I think there's more of a chance, although it's still not high, of one of these being put in place, like in the Twitter situation, when it's in reaction to something that's already happened, where it could be much more portrayed by Musk, for example, as a situation of the current board trying to keep its control for their own benefit, right? And that there are problems with Twitter and there are problems with the decisions that the board would make, and they're not looking to get thrown out. And also maybe they would even have liability in theory, again, tough claims, about making poor decisions in the past. And so, whereas if you've done it as part of your certainly original charter, or even if you've done it, way past that, but there's no activity going on, no hostile takeover going on, I think it's easy to argue that, hey, we didn't do this in response to anything. We didn't do it because we hate Elon Musk, or whoever your acquirer is. But we just did it because it was part of our governance, process and the decision that we made, and we thought it would be in the best interest of our shareholders. And I think it's just easier to justify, although still, likely you'll be able to justify it in a scenario like Twitter. I think there's at least more claims that somebody like Musk can make on breach of fiduciary duty if it's reactive than if it's sort of proactive, right? So there's a little bit more chance, at least. So it'll be interesting to see what Musk does on that. Whether I would expect that he and his team knew this would be coming because it's a standard, a tactical move, and they must have a strategy for it. Maybe they're going to sue to try to say it was improper. So it'll be interesting to see what happens over the next number of days and weeks. So it's interesting, just a couple of the companies that have put in these these poison pill shareholder rights plans in advance of having any issue, or companies like McDonald's, like Walt Disney, and then there's many others. It's an interesting time. I mean, I know, especially Musk is frankly, a lot of these hostile acquirers have always been divisive folks. Call Icon, in his group or whatever. Musk can be divisive in other ways, and there does seem to be what could be a politicized aspect of this, which I won't get into a lot of them to identify it, where Musk is talking about taking Twitter private and then having it be a platform where free speech is more broadly allowed. I don't know what that means in terms of monitoring or vetting or kicking people off the platform and whatever, whether he would change some of those decisions that were made. But so this can become a very interesting topic for other reasons, and for dramatic reasons and for political reasons and things like that. But it's also very interesting from a deal point of view, right? Pretty much all the deals we've talked about. In fact, I think I don't think there's been an exception on this podcast for the 160 some odd episodes that we've been doing it so far are all consensual deals, right? Because that's how generally deals get done. But a hostile takeover is just the opposite, right? Hostile takeover means that there's going to be a battle, and often the first offer that the buyer has made on a hostile takeover is never, the best offer. They're probably going to have to push up if there's any chance that they're going to get the deal done. They always leave room for that. And you've got a company that does not want to be acquired, at least by them. And they, and they're going to be fighting back. The other thing that happens sometimes in these situations is that, is this concept of a white knight. And what is a white knight? Well, it's, you see white knights in the movies for, saving the damsel in distress or those kind of things. Well, that's where the term comes from. The white knight is sometimes a company that will come in that is a more acceptable choice to the existing management and shareholders to buy them. So, this would be an example. Let's use Twitter because that's what triggered this whole solo cast. So Twitter's in play. Musk has bought up 9%. He's going to potentially buy up a bunch more, going to take it over. Maybe someone else sees an opportunity and approaches the company, or the existing management, et cetera, has relationships at another company that they'd be much more comfortable being acquired by other than Musk. And either by the reach out by that potential other acquirer or the inquiry by Twitter to or the invitation, another company gets involved as a potential buyer. And now we have two or more companies vying for the acquisition of Twitter in this example, and one or more of them might be favorable, white knights or friendly deals versus the hostile acquirer deal. Now, the other thing you have to this is because, of course, if you were a privately held company, right, there's no way to take over a privately held company. So if you have potential buyer choices and you don't like one of them and you like another one, you can just go sell to the one you like, right? You don't have to do business with the one you don't like. But in a public company with all kinds of fiduciary duties and where there's the ability to buy equity on the public markets, right, where you can't necessarily prevent somebody from just buying up more shares from other people who own them, right? A lot of people own Twitter. Anybody could sell their shares to Musk, including, an individual investor, but more likely institutional and other bigger investors who may be, aligned or see the opportunity to get out at profits because he's paying a premium. It's very different than in a privately held situation, because in the public situation, you don't always have a choice as the management board, majority shareholders of the company, to guarantee that you'll do a deal with the company that's friendly as opposed to the company that's hostile. But it does prevent another alternative. And, the board can then consider the various offers and decide that the friendly buyers are better, right? And decide to sell, to them. And also, they may come in and start buying up, equity as well with the company's stock with the company's blessing. So, it'll be interesting to see how that develops in this case. Many of these fail. And listen, this is the interesting part about the deal for the hostile acquirers in a hostile takeover, is even when the deal fails, meaning that they don't get to take over the company, it doesn't mean that they lose money. Sometimes they might, right? Sometimes maybe they're buying equity, especially if they continue to buy to try to increase their share as the price goes up because the company's in play. So we've seen Twitter stock go up. Because Musk offered above the offering price, so it's sometimes or the public, the public price. So sometimes, the value will go up when the company's in play, especially now if you get multiple buyers and they start, in a bidding war, which happens sometimes, generally. And by the way, they could even be other hostile buyers as well. So what happens sometimes is, sometimes, listen, once things start to fall apart, the stock drops and a hostile acquirer could take a loss. And there's been examples of that. But there's also been many examples where, okay, they don't achieve their objective, but they actually make money because the stock ends up higher than when they bought it. And when they sell out, either just to give up and go elsewhere or as part of some sort of settlement, they actually make money. And sometimes what they do is they will leverage, in order to settle a deal, maybe they don't get control, but they will leverage maybe some sort of access or a change in governance in some way, or, a change in policy. Maybe this is what some of what they call the activist shareholders try to do, force change. So sometimes those kind of things come out of this. But, in general, the main goal is usually to take over the company, and they're successful or not. But again, the interesting part about this deal is that just because you don't achieve the objective doesn't mean that you don't make money on the deal. You could even make money on the deal in that case. Listen, I thought this was a fun topic. It's in the news now. It's not the first time this has happened. But I think because these hostile takeovers are less common now, and because it's Twitter, and because it's Elon Musk, and because Twitter has been very politicized because of certain decisions of, different people being blocked in access and who should and how it's been used, I think this one is going to get a lot of general attention beyond, just in the deal space. And a lot of people are going to talk about it. And inevitably what that means, there'll be a lot of misinformation that's going back and forth. Yes, sometimes for political reasons, but just also because, there's a lack of sophistication sometimes, in terms of, how things are reported and talked about, and they're reactive and they're judgmental. But this is how it works. So it's an interesting. If you get down to the core, of the legal part of it, the interesting part will be with the assumed challenge that will likely come from Musk, can the Twitter board justify that this was done in the best interest of the shareholders? Again, the deck is stacked in their favor on this, but that doesn't mean that they're 100% scot-free. Will Musk be able to buy it even if the company's stock is diluted and devalued? Will another player come in to create competition, friendly or not? Will that put Twitter in play where it will get sold to somebody? And if so, what will that deal look like? What would be the impact, obviously, on Twitter if there was a change of hands, or even if there's a leveraging of some change of policy based upon some agreement? I think it's going to be, even outside of the drama of it, I think there are some, interesting legal and also strategic. This is, people who know me know I love strategy. We figure out strategy on deals all the time. We figure out strategy on how to, even get disputes, and things, closed and that kind of stuff. And this kind of thing is all about strategy. That's what a poison pill, a shareholders' rights plan is. It's a strategic move to make the company less valuable only to the people who are hostile trying to acquire it, and to protect the value. It would be the argument of the existing shareholders. That is a strategic move. And obviously, like I said, I am sure that Musk and his team have anticipated this, which means they have a strategic move coming to try to counteract that, whether it's litigation or something else. And it'll be interesting to see what happens there. So that's a bit on shareholders' rights plans, or poison pills, as you probably hear about them more in the media. It's an interesting area. By the way, just to make clear, if Musk is successful, it will end up, with acquiring control of the company. So that would be the deal that he want. And what does that do for him? That would, if he's successful in that, depending upon, again, what's in the governance structure, because there are other things you can put in place that are like poison pill type things, where it creates some ability of maybe certain classes of shareholders to appoint board positions, all these things that you can do. But in concept, potentially, barring those things, if Musk was able to take over, he can get control of the decision making of the company, potentially, put up a slate of board members that were more favorable to him. either now or it might take time as people's terms evolve out, and and then take Twitter in a different direction. In fact, he's talking about taking it totally private, which would mean buying all of the equity, and in which case, if Twitter is no longer public, it really gives him way more flexibility and control over what he can do with it. So it'll be really interesting to see, folks. I'm going to be following it, and you can follow it now, maybe with a little more understanding or knowledge when they say poison pill, what that means. So until next week, when we'll be back with another great guest. It's been great talking to you about Twitter, Elon Musk, poison pill, shareholders' rights, and some of this fun or dramatic, however you want to look at it, stuff that may come up around this potential hostile deal for Twitter.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. Join the DealQuest Deal Den Zoom calls, a free monthly 90-minute mastermind. In the mastermind, we address all the challenges you may be facing and help support you with the opportunities that may arise in terms of deal-driven growth. You will get input not only from me, but all the members on the call will collaborate and serve each other in a mastermind format. To sign up for the free mastermind, go to www.corykupfer.com/dealden. That's corykupfer.com/dealden. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.